Okay, we have a few people that weren't here yesterday. So could we maybe do like a quick 1 minute review of each section about what we talked about yesterday? And then we'll dive into the new content today. So could someone give me a quick 1 minute recap of the industry? We'll start with the industry. Did everyone already forget what we did yesterday? Jack, you know what's going on in the industry. Give me a quick rundown of what happened in the wine industry.
All right. Yeah, so the wine industry, it's a pretty steady industry. It's not very it's been in like the industry for a while, so there's not huge growth rates. And as well in BC, it's the second largest contributor to the wine manufacturing market in Canada. So it's good for our company, Smith Wines, which is located in BC. And then as well, we're also in 2021, so we're also considering the impacts of COVID-19 and all of that, kind of what's going on there. And yeah, that's pretty much for the industry. It's pretty stable industry, COVID-19, and then yeah, I think that's kind of what I would kind of give a quick summary for the industry.
Yeah, I agree. Like, it's not a crazy growing industry. We pretty much reached our max. We've kind of leveled out in sales growth. That means that we might have to look to something else to try to see top line growth, to try to see revenue growth. And then there's also the impact of COVID and how that could affect things in the future. All right, what about our competitor analysis? Who are our competitors and what do we think about them? Yeah, Jivan.
First we have Andrew Peller Limited. They're kind of a direct slash indirect competitor, because they have full vertical control from production to distribution, and they're the largest wine manufacturers. We can beat them out because we have the personal connection between customers, whereas they're like wholesalers. Um, our biggest competitor is probably Mark Anthony Wines and Spirits, and their Cedar Creek Estate Winery because it's like medium price range. It's similar to ours. They have a restaurant, which is what we're looking to open, so they'd be a big competitor. And they have multiple locations, and they're highly reviewed on online websites. And then the local wineries, I think I forget who brought up the point, but they brought up a good point that their average revenues is significantly lower than us, so we can definitely beat them out revenue wise. And they go through a similar style. They go through like personal connection, word of mouth. So we would need to compete with them on that.
Absolutely. What I really liked in your answer, Jivan, is you really got into who was our direct competitors and who was our less direct competitors. So Andrew Peller, which is this massive public company, they don't have that intimacy that we do. They don't have that same kind of experience that we do. But you did talk about the vertical integration. Vertical integration means when you own every step of the sales process, from the point that you manufacture the wines to you distribute the wines to you sell the wines. That means you keep all of the value across the whole chain. Smith Wines doesn't have that. We can sell directly to our consumers at the physical location. However, if we're selling our wines wholesale, we're losing some of that vertical distribution. So they're probably not our biggest competitor, like you said, Jivan. However, some of those smaller wineries that also have that strong in-person experience that are doing, a very similar thing to us. However, their size is a lot smaller. They're averaging like $745,000 in revenues versus I think last year we did like over 1 point something mil in total revenues. All right, great summary so far. Who can help me out with the competitors? Quick, or sorry, not competitors, customers. Quick 1 minute summary of our customers. Yeah, Rock.
We had three main customer groups. First one that we kind of looked at was young socials, but we found they made up the lowest percentage of our sales, and that they're like a good choice in aligning with their goal to be more like young and get young people with wine, but that they're going to be like the least receptive to our products. So that we thought like economically it wouldn't be the best choice for us. especially compared to the other options. So that's why we went with like enthusiastic, kind of like middle-aged people, I'd say. I don't remember what the title was, but basically made up 75% of our sales, so that was the largest group. And that this still meets with our goals of having like young people, but that also because they're like the fastest growing group in like the wine age people, that could kind of make up for like a lower overall industry growth, could kind of like offset that. So that was another plus there. And then the other group that we looked at was like mature, sophisticated people, made up 20% of sales, but they more purchase like a lot of more expensive wine. And since they're kind of experienced, like they kind of know what they want, and then they wouldn't really support a goal, like align with our goal of having more young people, and that they might not be as receptive to a lot of like that other activities with the winery, such as like the restaurant and whatnot.
Yeah, absolutely. So the first group, the young socials, they're tiny percent of sales. They probably help us with like our goal of achieving a fun atmosphere. But in terms of a revenue perspective and profitability, they're not our number one target. Our number one target is probably those enthusiastic adventurers that are spending a little bit more money, are starting to learn more about wine, and you can probably start to develop some loyalty with those people as well if you're delivering a good experience and also good wines. And the last group is probably the most profitable of the three groups. However, they might not fit with the company's goals of what kind of environment they're trying to achieve, but they definitely shouldn't be ignored no matter what we do. All right, corporate capabilities. Who's the company? What were some key things to remember in about our company? Yeah, Alexa.
They've got a lot of experience and have had successful businesses, and they're also basically funding their own business. Um, yeah.
It's definitely part of it. So they've had a lot of successful businesses. They created Saks underwear, and then they also created a cannabis company that they sold for several $100 million. Back when all those crazy transactions were happening in that industry. Guarantee you, whoever bought that company regretted it now. Outside of their past success as entrepreneurs, what else is going on in their operations? Like, what's a little bit about going on with them? Yeah, Vish.
They're very reliant on direct to consumer sales, which we saw in our accounts receivable, and that's why they were so low. And then they also won a bunch of awards in the previous year in 2020. So that showed us that it was like a good time to grow and expand the business, since right now they're just operating out of their own home. And they also own the property that they're looking to expand to, which is an important fact to consider because that is obviously going to save them a lot of upfront costs in terms of building a new facility.
Nice. And what I really liked about that last part that you said there is you said not only what does it matter that they own it, but it's going to save them those upfront costs. It's going to save them those investments. That's what we're looking for is for you to make connections to some of those financial tools in that first part of the analysis. Fantastic. I'll quickly do a quick recap of the statement of cash flows, and then we'll do a quick recap of the ratios, see if there's any questions, and then dive into the new stuff. So when we're talking about the rate or statement of cash flows, what we really discussed the other day is that you want to go through this in an organized manner every time. The way that you want to do that is always starting with operations and net income, then talking about your working capital, and then if there's any other sources and uses from operations. So doing a quick recap of that, everything here looked to be pretty good. Our net income was a source of cash both years. Makes sense. The company's been operating for 6 years. Appreciation is also a source of cash to be expected. Working capital in 2019 is kind of how we'd expect it to be, where this is a use of cash, and source of cash. However, in 2020, that working capital looked a little bit more concerning because this was a use of cash, and use of cash. So all three of our working capital accounts in 2020 were uses of cash. I don't love to see that. However, when we look at our net cash flow from operations, that was a positive source of cash, which is almost the same as our net income. So not the end of the world. Looking at other major sources and uses, we saw that they majorly changed how they were funded. They paid back their debt to shareholders, which is why this was a use of cash of $621,000. And they funded that with shareholder contributions, which totaled $552,000. So they pretty much went from financing themselves with debt to financing themselves with equity. That is a key component of this statement of cash flows. In my opinion, to get an A analyzing the statement of cash flows, you would have to make this connection here. It's just a core thing of how the company's being financed. We saw that their net purchases was a use of cash in both years. To be expected, they're a growing company, they're still investing in new assets. In terms of their matching, when we're talking about matching, we're talking about cash flow from operations, cash flow from financing, and cash flow from investing. They did different things each year. In 2019, they used their cash flow from financing to fund their losses fund their use from operations and to fund their use in investing. That's okay matching, but it's not sustainable long term. You can't keep getting money from financing to fund your loss from operations. The next year, they had a little bit more sustainable matching. They used their net cash flow from operations to fund their use of cash and financing, and they also used the surplus to fund their net purchases. Different sort of matching in 2020, however, more sustainable, more acceptable. I like that kind of matching in the future. Before we move forward to the ratios, any questions about the statement of cash flows or anything else we've talked about? Yeah, Jess?
What would happen if we saw the third scenario here where your net purchases were funding both your operating and financing activities? Like, would that be good? Would that be bad?
Oh, that's bad. That's bad because that means you're selling all your assets. And if you're selling all your assets, how are you going to make money in the future if you don't have assets? So that's a situation that I would almost very rarely expect to see. And if I did, it's very rare, but we don't like that.
Okay, thanks. And then just one tiny question. Can you explain again just like why it's really bad that or not ideal that our AP is also a use?
It's like if, let's say hypothetically, Jess, let's say like you didn't pay me for the session yet. And let's say you were going to pay me in a month from now. Well, that's a use of cash of a month for me because I don't have the money today in my bank account. And then let's say my landlord says, Raphael, normally you have to pay me at the end of the month, but today you got to pay me on the first day of the month. I'm not receiving my cash from you, my customer, and I'm not able to have the cash to then pay my accounts payable because it's due immediately. Both of them are using up my cash. Both of them are putting me in a cash squeeze. Does that make sense?
Yeah, thank you.
Why didn't I factor in prepaid expenses for the check mark? It's such an insignificant number. It's $800 and $343. I'm not concerned about it. It's not driving a major change. I'll get back to that other question that you have there in a second. Bish?
I just wanted to ask on the actual exam, I'm going to assume that they're not going to be marking like our statement of cash flows if we mark it up. So everything that you just kind of analyzed right now with the sources and uses of cash, is that something that we have to actually write out in our book and kind of highlight some things that we're concerned about? Or can we just jump into why we're using which ratio and what it means?
I think you want to talk through the way that I talk through it. Now, any markings that you do on the actual case don't get graded. It's only what's in your notebook. So I kind of do the markings on the case to show you what I'm looking at, but the way I was talking through that is what you would be writing down in your notebook. And then when you get to your ratios, that's where you'd be analyzing your ratios. Nick, that's a great question. So matching cash flow from operations to cash flow from financing, cash flow investing, that's what you do when you're a mature company. That is the most stable form of cash flow. That's what you'd expect to see from Apple, Amazon, Google. They have so much money from their core operations, they don't have to go and get outside financing. However, when those companies were growing, if you think of each sections of the statement of cash flows as a source or use of cash, the way you're going to grow the most is if cash flow from operations is source of cash, if cash flow from financing is also a source of cash, and then you're using both of those to fund your investing. This is what you would see as like hyper growth, because you're not only using your money, you're also using the bank's money to grow. That's what you'd expect to see in the highest growth situation. However, it's not always the most sustainable long term, because it's hard to say if you should always be taking out financing, whether it's debt or equity. However, it's how you would see the most growth overall, because you're getting money from your operations as well from your investors or lenders. Why would this company switch from debt to equity if it is preferable to use debt in terms of financing? That's a good question, Dom. I don't fully know the answer here. Because in this case, they can afford the debt. They have strong interest coverage. They have positive net income. They might be trying to take some debt off their balance sheet, maybe if they're looking to take on a future loan, or maybe just for their own personal reasons. There might be tax implications that we don't know from the case. But in general, that is correct. We would prefer debt financing because debt is cheaper than equity. Thank you. So matching primarily from financing and investing is alarming red flag. What do you mean by that? Can you just ask your question? Like a majority of your money is coming from those to finance other sections? It all depends. We can't really say like this is always a red flag or not. I think if it's coming from investing, that's a red flag. Because investing is your company purchasing new assets. And if you're selling your assets, that means you're getting rid of them, which that's a big red flag. If it's coming from your financing, that's to be expected when you're starting out. However, that can only continue so long before investors are kind of frustrated. If we have more questions about statement of cash flows, more than happy to stick around at the end and answer any of those questions. So when we were talking about the ratios, I think it was Jibon, maybe someone else made a good point that we probably don't want to use Andrew Peller as our comparison, because Andrew Peller operates in so many different verticals than we do. The industry is probably the better competitor in this scenario here. I'm hoping that one of your big takeaways from ratios yesterday is every ratio is an X over a Y. When that ratio changes from one year to the next, that means either your X is going up, your X is going down, your Y is going up, your Y is going down. That's what my A+ students do. They go and they look into this formula and really examine why the ratio has changed so much. In this scenario here, I'm gonna make a correction of something that we were talking about a little bit yesterday. You will always do a vertical analysis every single time. I think if you guys heard your teacher say you don't have to do one if it's profitable, I think you heard wrong. I think you do a vertical analysis every single time. Doesn't matter. Companies are always trying to improve their profitability. And the way you improve your profitability is by looking into your financials and doing that vertical analysis. In this scenario here, I would expect you to talk about the biggest line items. I would be expecting you to talk about the cost of sales, the wages and benefits, and probably also the advertising and promo. This case probably has like 500 plus numbers in it you could talk about. You're trying to pick out the ones that have the biggest impact. You don't have to discuss everything on here. You're just looking for the ones that are having the biggest difference or biggest control on your profitability. So that's what we talked about for the vertical analysis. And in terms of that, things are looking fantastic. Our net income is nicely increasing every year. And I think it was Anish. Could you talk a little bit about what you said about the cost of sales the other day? Do you remember that?
No, I don't actually.
It had to do with the vineyards being leased.
Oh yeah, I said it was their own property, so they're just leasing it, and then that's just like this is not like a real expense, but like it just keeps it down, so it's better for their taxes and stuff.
Can you explain that to me a little bit more? Like I'm like 10 years old. We'll say 15 years old, maybe.
15 years old. Like if you have your own land and you do stuff on your own land, you don't pay any expenses. So you have like you would have made an extra $10,000 than like if you had to lease it. So then you have a land that's owned by yourself, but it's under a different company. So then you just charge yourself basically. So you charge this company from your other company, and now you're paying an artificial expense of say $10,000 to lease the land. I don't know where it says it, but whatever, say $10,000. So now your income goes down and you pay less taxes, but in reality, like you're just moving money from this company to another company and you just pay less tax.
Exactly. I have a funny example like that in real life. I remember a friend of mine, his dad was like pretty successful, and people do some interesting things to lower their taxes. And pretty much what he did is he had his son as the owner of like a BMW M3 when he was like 8 years old, so that you could have it as like a company expense or something like that. And so that's pretty much what's happening here. They're just moving it from one pocket to the other, which is a good thing. Zaina, I think I saw your hand go up.
Oh no, I was just gonna say, like, while Anish was explaining it, like, I didn't understand it fully until you said, like, it's as if you're moving money from your left pocket to your right pocket.
Exactly. So to be honest, like I'm not expecting you guys to get all these points, but I am shouting them out because that's what the A plus people do. They really get into the details of the financials and go beyond just saying, oh, we had our net income's increasing every year. That looks good. Like we're really getting into the details behind it. We talked about our working capital, that we don't particularly love it, but it makes sense given the context. Context. You hear that word over and over from me in these cases. You have to always be giving it a point of comparison. If I saw 420 days of inventory, I would be highly concerned until I then learn that it's wine and it doesn't go bad. When I compare it to the industry, we're about twice as high as the industry, which I don't love that. However, you could also think the industry might have a lot of just like really cheap, not so good wines that maybe are aged for less time as well. Our age of receivables being 10 days makes sense. Nish, I think it was you that talked about us being direct to consumers, so they're paying almost right away. We have very low days of receivables. Our days of payables about 1 month. I mean, that's good for our suppliers, but for Smith Wines, maybe they would want to try to push that a little bit longer so that they could have more cash available to them. All right. Our quick ratio, we had some discussion about this at the end of yesterday. What's the difference between quick ratio and current ratio? Yeah, Jess?
Current ratio takes into account inventory where quick ratio doesn't. So when our inventory is wine, for example, and it doesn't move quickly, it's better to use quick ratio because it's a more accurate number because our inventory doesn't go to liquid as quickly as if you were to sell t-shirts that goes with like trends and stuff and people buy them quickly. So you just have to kind of look if what your inventory is and if it makes sense to do current versus quick.
Absolutely. So how liquid is your inventory? How quickly can you sell it? And this, I think when you look at the difference between our current ratio and our quick ratio relative to the industry, I mean, it makes sense given how much inventory that we have. I think that could be seen as a little bit concerning. However, there's still only a 6-year-old winery. They're still figuring things out. And we saw that the process from growing grapes to having a bottle of wine can take years. So again, it's not something that we love, but it makes sense given the context of a winery. All right, the last thing to discuss here before we get into the new stuff is talking about this right here. Can someone help me understand the total debt to assets and the interest coverage and how those two are related as well? Yeah, Jack?
Yeah, this was related to like the X over Y method because since that like due to shareholders and the shareholder contribution. So in the debt to assets, we significantly decreased our debt. So that's why the number's different. And then the interest covers the same amount. So now we can technically cover more just because we don't have as much debt on our accounts.
Exactly. So when you look down here, and Jack, I love that you talked about that in specific, our liabilities went from 777,000 to 244 because we got rid of this due to shareholders and structured it as equity financing. As a result, but our total assets are still increasing. So we really changed the way the company's financed. When you get rid of a major portion of debt off your balance sheet, naturally your interest expense is also going to heavily decrease because your interest is based on your debt outstanding. This is something that frees up a lot of opportunity for Smith Wines if they wanted to take on more debt. I guarantee you a bank would look at this and look very favorably because they have very few liabilities and their interest coverage is so strong. Jess?
I just have a quick question going back to that quick ratio, but if we want to continue going with this, we can.
Let's keep talking about this because this is rather important. I think the quick ratio we can maybe talk about at the end. This is what's called your capital structure. That is how your company is financed, whether it be through debt, whether it be through equity. I can't understate how important that ratio is in the world of finance. Everyone is caring about how is your company financed. If you have a high debt to equity ratio, that's not a bad thing. People that I've met with personally probably know the answer to this, but people that don't might not. What would you guess is Apple's debt to equity ratio? Put it in the chat. If you put 2, that means for every dollar in equity, they have $2 in debt. If you put 1, that means that they're equally financed. If you put less than 1, that means they have more equity than debt. What would you guess Apple's debt to equity is? Get a few more answers. See like 10 answers. Carson, you put the highest number of anyone, 10. Can you explain why you think Apple's debt to equity is 10?
Honestly, I have no reason why I put that or not. I'm just gonna guess.
No, come on.
I don't know. I just feel like they were taking a lot of debt. I don't know. Debt's cheaper. Apple people are smart. I don't know.
Keep going, man. I know you're a smart guy. Because you're not far off. So Apple's actual debt to equity ratio is like 6, meaning for every dollar of equity, they have $6 in debt. The reason why it's so high is Apple can pay their debt with no issues. Apple would rather take out big loans, use that because it's tax favorable, they're not giving up any ownership, and they can pay it off over the next 5, 10, 20, 50 years. That's why Apple's debt to equity ratio is so high. However, if Apple was losing money and their debt to equity ratio was that high, we would be highly concerned. Debt is an amazing thing if you can pay the interest and pay it off. Debt is a very bad thing if you cannot pay the interest. If you are having trouble making your payments, that's how you go bankrupt. All right, any questions about the ratio analysis? Yeah, Rock?
Or just to confirm, for every single ratio we do, you want to talk about the X and the Y? Or for some of them, is it more important about like their fit? Or for some of them, is it kind of like both?
I think for like when you're talking about, for example, like the efficiency ratios, you don't really need to. Because those speak for themselves when it says, oh, it went from 486 days to 419 days. However, I think when you're talking about like any of these ratios up here, getting into the X and Y's is a great thing to do, especially with like a return on assets, debt to assets, interest coverage, that kind of stuff. Because then you're really getting into the details of what's causing that change. Nick, that's a little bit of a more complicated question. Maybe I'll get you to stick around at the end to ask that. Zaina?
I think you went over this yesterday too, but if we're not given these industries on the exam, do you think like these 12 are the ones that we should talk about 100%?
You will be given the industry ratios. You'll always be
Okay.
given your competitors so that you have something to compare it to. I mean, I'm a little bit biased because I wrote this case and like, I love these ratios. I think they tell you everything you need to know. So I would always be choosing from these more or less. It's hard to say like, always do this, never do this. Like, I think you guys like the word always because it makes it easier. And I hate the word always because I say we got to apply context to the situation. So that's kind of my answer there. All right, any other questions about anything that we've done so far, or are we good to get into the new stuff? All right, good stuff. Hopefully that's a good recap for people that were not here yesterday, but have joined today, or if, I don't know, maybe you had a big night last night and you forgot what we did yesterday. All right, let's talk about the differential for a second. How did the differential go? I know, well, we were starting, a few people said their answers, but let's dive a little bit deeper into it. I guess before we start the numbers, let's qualitatively assess the differential options. Now, let's go beyond just the obvious of like, oh, bigger facility, more people. What are some of the pros of the new production facility? What are some of the things that we like about that option? Just the new production to start. We'll talk about the restaurant after. Yeah, David?
I mean, the fact that we're operating at 90% capacity in the current facility we have, it'd be a good idea to have the extension of the new facility allowing to maximize our customers.
Absolutely. And to take that one step further, David, let's say if we're at 90% capacity, we're almost close to being full. If we're full, we're going to have to turn away customers. If we're turning away customers, we're turning away revenue. That makes me more inclined to go forward with it. I need to see the last piece of the connection there for you to go above and beyond.
Okay.
What else do we like about the new production facility? Carson?
I think based on the high competition in this industry, I feel like an expansion is a smart idea. Like at least more revenue, like it says like 5 times more visitors, like it just builds more awareness and builds on our already advantage of like a more in-person experience. Even adding a restaurant, we could even build on that as well. So yeah.
Absolutely. And I think looking at that professionalism piece, right now they're operating out of like a massive garage essentially. And so if you have like a full new facility, that's probably going to bring a bit of a wow factor. Anish?
Most of our money is made direct to consumer, and it's our highest margins. So if there's anything that we should focus on, it's definitely this, because like, yeah, it's whatever, 1/4 of the new guests, and then they buy an average bottle of like $28. So if that's where we're going, like if there's anywhere we should focus on, it should be that. So
What I really like about that answer, Anish, is twofold. I like that you got into the contribution margins and the direct to consumer has the highest margins. And I also like that you brought in the $28 for the bottle of wines. We're getting specific. We're not just saying like, oh, I think this is a good idea, but you're telling me exactly why you think it's a good idea. Good stuff. Georgia?
They sent out surveys and had really good feedback, so we know people would be interested in it.
Absolutely. So we already have interest in this. What do we not like about it? What scares us about going forward with this new production facility? Jivan?
We already had issues with selling our inventory compared to the industry. So I think that getting an even larger production space, like first of all, how are we gonna deal with this like new production style? Like, does that mean that we're making our wines faster, which means we're holding on to them longer? And then also, how are we gonna sell all this new inventory that we have?
Again, same thing that I said to Anish. Jivan, I really like that you're getting specific, especially talking about the working capital items and the inventory. I like being specific. I don't like very general points that it could apply to anything. Jack?
Yeah, another thing that I saw was it was only like 700 meters away from its old facility, so it's also it's not really gonna impact. I feel like it could have an impact on sales, and like we're not reaching as diverse of a market as we hoped, or like it's not like 1 kilometer is not that far, so it's not really gonna change our sales, and everyone's in proximity to it, so it's not gonna really have a huge difference, I feel like, on grabbing a whole new market. So I think that's also another consideration to have.
Absolutely. I like that, again, we're getting specific with the things here. It's just down the road. It's like it's like a 10-minute walk away. So we're probably not necessarily going to be like in a whole new market, like you said, Jack, but we just have more space to welcome people. Okay, good stuff. I think one thing we didn't talk about is COVID. It's 2021, COVID is rampant, there's shutdowns everywhere. Is now the right time to expand, or do we think it's maybe too risky? On the flip side, you could also maybe make an argument saying now's a good time to expand. Because it's COVID, there's a downturn. Maybe now's the time. If we're not operational, it's not the end of the world. I could see you taking a case fact and going one way or the other with it. It's all about the justification more so than the actual answer. Bish?
I think in the case it talked about how the COVID-19 travel restrictions were going to be less prominent. And because we know that BC, I think, has like the second biggest, like, I forget what it was, maybe the winery industry in Canada. This would be where people are visiting, or like tourists would be coming to explore wineries anyways. So them having like a bigger and more attractive location and space would attract these tourists to come visit their vineyards. So
Absolutely. So seeing like how the economy is going to open up, maybe being in British Columbia, what are some of the pros of that? For sure. What about with the restaurant? What about when you add the restaurant on top as well? Do you guys like that or not like that idea? And why? Yeah, what do you think, Rock?
I was gonna say, like, going with the restaurant allows them to meet their goal of having more like parties and just like larger events there, because that's like a space you can hold it. And then also I kind of brought that back in the competition because there's a lot of local wineries in like that BC Kelowna region. While there's some big ones, a lot of local ones that are close together are going to be a lot of our competition. And the big factor for us was being different than them. And I forget which winery it was, but one of them didn't have a restaurant. And that restaurant aspect can add more of like that close feeling for people and more of like an experience. And then I just like put another goal point saying like potential loyal customers and whatnot.
Absolutely, we're really focused on the experience. That's, I think, one of the things that we keep on driving in, or keep on getting into that specific point, which I agree with. The experience is very important. And having a restaurant will just maximize the experience. It allows people to not only have a drink, but maybe stay a little bit longer, have food, and also allows us to compete with our competitors. This is where you got to take it beyond the case and think of what this actually looks like in practice. Think of when you're going to wineries. It's summertime, it's hot, you're drinking wine all day. You also sometimes need to have food, or else you're like that person who can't handle themselves throwing up at like 2 p.m. So the idea of having a restaurant in practice is probably something that's even more appealing than it sounds like on paper. What else do we think about that idea, Anish?
The margins compared to our margins are like very low. It's like what, like 3.4%. With all the positives, if we're like the reason that like 3.4% might be like somewhat misleading is because we don't have to deal with any acquisition costs at all. We have one price meal at whatever the price was, I forget. And we could up those margins compared to the general restaurant industry. And then even though if this isn't like the biggest cash cow, it just adds to our experience. So it's not really as bad as financially it looks on paper.
And that's an important thing to say is like, you know, it's not always about the dollars at the end of the day. Sometimes it's about how it will affect the overall company's, I think you could use the word like financial statements. And I agree, you having a simple menu, you don't have 30 different options, you have one fixed price menu a day, that's all they're making, that's all they're doing. As a result, maybe our margins could be a bit better than the other restaurants. However, we've never operated a restaurant, so there could also be some growing pains with that. Carson?
Yeah, I was just gonna say on the negative side of things with the restaurant is, we give in the case fact about the industry and how it tends to close quite often or in a year or two. So it's a risky investment. You never know what's gonna happen. It could be good, could be bad. It's just and how you look at it. So yeah.
Absolutely. And like when we go back to the idea of just building a new production facility, these founders care about legacy more than anything. And when you're thinking about legacy, building like a new multi-million-dollar facility is helping cementing that legacy. And based on their previous experiences, they're not short on cash. They have money, they have resources. So when you're looking at building just the new winery, that seems to be quite an appealing idea. When you think about adding the restaurant on top, there are points that I like about it for sure, but there's also some risky things of like, what if we have to shut it down? What if it's not successful? What if we just don't know how to operate a restaurant? Operating a restaurant is quite different than operating a winery. It's also quite different than their previous experiences. So I don't know if I like necessarily want to say like I love it or hate it, but somewhere in between the two. All right. How did the differential go financially?
I think Rock has a quick question in the thing.
With the restaurant point, would you have liked me to tie it back to some aspects related to financials or quality? I think your point was good, Rock. I don't think you have to tie everything back to financials. That's something I want us to be careful about. When I'm saying let's always make a connection, it doesn't always have to be the same connection. If it's the same connection, it's going to become very repetitive. However, you always want to connect it back to something. So Rock, what you did is you connected it back to our competitors. That's fantastic. If you're making the connection to our customers, if you're making the connection to the industry, if you're making the connection to the financials, all of those are valid. The key thing that I'm trying to get across is that you always want to be making one of those connections. So it doesn't always have to be to one specific point, but when you're thinking of your exam, think of it as like a spider web, and everything is all going together so that when you get to your decision, it makes sense. It's not like a big surprise. Good stuff. All right, differential. What did you find hard about it? What did you find maybe not so difficult? Like, how did the differential go? Yeah, Rock.
When I did it, I think I did a good job identifying if something's going to be like recurring versus a one-time sort of cost. But then something went wrong when I did like my investments versus my outflows when I did the calculation there. And I think it might have been something to do with like that actual building cost itself. But then the thing is, I kind of kept like the same formula for a lot of information, just attached it onto the winery. So that also messed up that equation there. So I think just kind of want to see like what I went wrong with maybe.
So that's why I like to have this idea of like gut checking your numbers. I mean, like, does this make sense? Does this seem realistic? If you have a negative total net cash flow, that probably doesn't make sense. You probably did something wrong. So we'll talk about a few things in specific to look at. Georgia?
I think my outflows were pretty good. I was understanding that well, but yeah, again, the sales of like if they buy a bottle of wine, what would it be, the $10 tier, the $20 tier? Like which one would you take off? So that was what was kind of complicated.
Definitely. It was, I think I got a little bit tricky on that differential. Maybe a little bit harder than some of the other differentials you've seen, but you can imagine that was intentional. David?
Yeah, I was a little confused with the wording for one of the parts. Like when it said 5 times the number, I didn't know if that was like to include like all those 5 times the customers are only in the new facility, or if that's total. So then the part of it you shouldn't include only the different parts. So yeah, I was a little confused with that as well.
I like that you're bringing that up because can everyone write in the chat, what are the 3 criteria to be included in your differential? Great. Looks like a lot of people are on top of this. It has to be future, it has to be cash, it has to be different. If it doesn't meet those criteria, then it's not necessarily done correctly, or it shouldn't be included rather. So I'm gonna share my screen and we're gonna go through the differential together. I'll show you how I'm laying this out specifically. So I have my inflows on the left, I have my assumptions, and then I have my 2 categories on the right. If you have not set it up like this, I'll give you a minute for you to maybe take a new sheet of paper or something to create a new document that looks like that. While you do this, I'm just gonna run and grab some water and then we'll go through the differential together. So give me 1 sec. All right. I'm curious if anyone got the right numbers. It's a little bit tricky. Why don't we put, what was your number for the first thing, the $10 tier? I want to see if anyone has the number that I'm looking for. Just the $10 tier to begin with. A little bit high, Josh. A little bit high, Jack. So I'm looking for, I mean, it's the same whether it's the new expansion or the restaurant for the $10 tier. So what I'm looking for is this number right here. Did only 3 people try the differential? Looks like we have a few people with the same number, the 308,680. Mila, can you walk me through how you got that? Because I think there's like 3 or 4 other people that have that same number.
Yeah, I did. Well, I didn't actually do it. Like, I did all my calculations as one big one, but
Okay.
I just subtracted it now. Like, I did the total sales and then like the current sales and subtracted those.
Can you get more specific with your actual numbers?
Yeah, so like for that one, I did 7,717 guests times
Yeah.
5 and then times $10. And then I subtracted the 7,717 guests times $10.
Almost. I guess I stumped everyone here because I haven't seen the number I'm looking for.
Is it like to do with the wine bottle sales?
Yeah.
I did that separately, so I don't have that number, I guess.
So let me write it out. And guys, pay special attention to the way that I laid out my figures here. Notice I go, the title on the left is inflows, then I have my assumptions, and then I put my numbers. That's very important because Mila, if I could see your calculations, I would just take off like one small mark because you forgot one thing. However, if I don't see your calculations, I don't see how you got your number. And if I just see the wrong number, I give it an X. So I can tell you, Mila, you were close, but you forgot one thing. So let's show what to do. So last year in the $10 tier, we had 7,717 guests. You could multiply it by 5 like you did, Mila, and then subtract it after. Or we could just multiply it times 4 to make our calculation a bit simpler. That's the part that you got correct, Mila. Can you help me understand that logic?
Like the logic of multiplying by 4,
Yeah, and not multiplying by 5.
just because like 5 minus 1. 2, yeah.
And because more specifically, we're looking for what's different. Because last year we already had 7,717 guests. So if we're having 5 times the amount this year, like Mila said, it's actually 5 minus 1. So we're multiplying it by 4 for that reason. Does that make sense, everyone? I see 2 slight head nods.
Sorry, can you just like repeat your logic behind like why we're minusing the 1?
Yeah, I'm gonna shut that back out to you, Mila.
So we know the total, or like we can calculate the total future sales, but we want to know, like they're already gonna make a certain amount of sales with the guests they already have. So we want to know what they're gonna make with only the new guests, not including the guests that they would already make money from.
Perfect. And I really like the way that you said the new guests, because we're already going to have those existing 7,717, but we're not getting 5 times as many. We're actually getting 4 times because we would have had that 1x normally if we were continuing. Now, this is the part that you forgot, Mila. I'm wondering if anyone else got it. There's something else I should multiply this formula by. Alexa?
Is it like a quarter because a quarter of the guests purchase wine bottles?
Almost.
Oh.
You're on the right track, Alexa. It has to do with that 25%. But I'm not going to multiply this times 0.25. Carson?
Is it the opposite? Is it 0.75?
Yeah, can you explain to me why?
Because a quarter of them are buying wine, like wine bottles, so that goes into the wine purchases. We're dealing with the wine tasting. So it says it waived off the price of the wine tasting. So that quarter are not actually paying for the wine tasting, they're paying for the bottles. And so we're just calculating 3/4 of them because those people are actually paying for the wine tasting.
Perfect. Got a little bit tricky. Didn't just give you an easy number saying, hey, you're gonna have 1,000 new people multiply times $5 each. No, I'm testing the logic here. I'm testing two things. A, can you get the piece that's different, which is this first part here? And then earlier in the case, I said that 25% of all people end up going to buy a bottle of wine. And if you buy a bottle of wine, they waive the tasting. So only 75% of these people are actually getting charged for it. So the correct number that I was looking for here for the new expansion or with the restaurant stays the same was $231,510. Any questions about that? Or does that make sense now that you've seen how we're talking through it? And then, sorry, I guess in my formula here, I should also have times $10. All right, using that same logic in the chat, maybe you need to pull out your calculator, tell me what these numbers should now be. Your first number is correct, Paige. Yeah, that's the number I'm looking for, 122,520. Dylan, can you talk me through how you did that?
Yeah, so it's just the same as the last one. You're just taking your guess, so 2042, and multiply it by 4 again, and then multiply by 0.75 because you're not paying the tasting fee for the other 25%, and then multiply it by 20.
You got it. And do the same logic for the $40 tier. Maybe you guys could write in the chat really quickly, yes or no, if you were showing your work. Like, did you show your calculations? Yes. Okay. In the future, it needs to look like what I have here. Trust me, marking however many hundreds of exams I've marked before, if I open up your sheet and it looks like this, my life's gonna be easy. And if I open up my sheet and your differential looks like this, it's not going to be so easy. This is a good practice to see why we don't really want to format it like this. Like, I can't understand this here. It's really causing me a lot to try to go and figure out what's going on. The numbers are all like right on top of each other. A lot of things are like kind of crossed out. Take space. You guys have as much space. See how easy mine is? Even if you want to use different colors, if you want to use different pens, whatever it is, that's fine. But really show your work like I am here. All right. What should be the amount of wine purchases? What should that amount be? Write in the chat, what was your number for wine purchases? Yeah, Gabby, is that a question?
No, I was just gonna like explain what I did.
Sure, go for it. What was your number?
I messed it up, so I don't have a number right now.
All right, sounds good.
Do you want me to explain the process or no?
Yeah,
Okay. I just added all the guests together. So the 7717 and like the 244 and like the 2042. I times it by 4 for like the differential. And then times 1/4 because 1/4 people buy it, and then times the $28 average wine.
and what number did you get?
I didn't put it in my calculator.
Okay, well, you have the right calculation, so
Okay, perfect.
I like the way that you talked about that. Why are you doing times 25%, Gabby? Help me understand that. Gabby? Why did you multiply this by 1/4? Why did you multiply it by the 25% here?
Sorry, I just dropped all my papers. I did over 1/4 because we just took out the 25% of people who, you know, paid for the bottle, which didn't have to pay for the tasting. So that's where that extra 25% goes, and it goes into the purchases.
Absolutely. So for this, it said in the case 25% of people that were going to go for the wine tasting were also going to buy a bottle of wine. So that's why we did the number of guests that we had times 4 again, same logic for the times 4 as we did above for the $10, $20, and $40 tiers. Multiplied by 25% because that's the conversion rate that we get. Multiplied by $28 per bottle. That's how much the average wine price is, or bottle. So that I saw a lot of the correct answers in the chat, which looks great. So that was $280,000 and $84. Looks to be good. What about food purchases? Now, of course, food purchases wouldn't exist for just this one on the left. But for restaurants, what was your number for the food purchases? Yeah, Jessica?
Oh, I was just gonna explain my process.
Sounds good. What did you do?
So I added up like all the guests and then I times that by 4. So 7,717 plus 2,402 plus 244. Then you times that by 4 for the differential. And then it says, I think it says 20% of those people are the ones who go to the restaurant. So then I times that by 20%. And then they said it's a fixed menu, which costs $36. And then you times that by 36.
What was your number, Jess?
Oh, I didn't calculate my number, but because my number was off, but.
I'll give you a hint. Your number's still a bit off.
Oh.
Almost. Jack, can you help correct the mistake?
I think you multiply it by 5 because the restaurant is different, and it wasn't in the initial sales before. So, I got $360,108.
I like it, Jack. I like it. Remember, we're going back to the criteria of a differential, and it has to meet these 3 things. 1, it has to be cash. Check. 2, it has to be different. When we're talking about the wine sales, they already are making wine sales. That's why for those we just multiplied by 4. However, the restaurant is a totally new thing. Like Jack said, we've never operated a restaurant before. So for the restaurant, that one we have to multiply by 5 because we've never had a restaurant. And it meets the criteria of different. We've never had it, so that's why we multiply it by 5. Seems like a decent amount of the people in the chat put 360,108. A few people put the 288,000. Alexa, I'm guessing you multiplied by 4 instead of by 5. But now you know going forward. So my total inflows for just the winery and production facility is $663,000 and 394. And if I go ahead with the restaurant as well, that bumps up a decent amount to over $1 million. And 502. Now, a little formatting thing. For my numbers, if you're writing them organized like me, just having the space is fine. But if you write your number like all together, like 663,394, then use a comma so that I can very clearly see that it's thousands of dollars. These are little things that make a difference. It makes it easier to read your exam. It makes it easier to understand what you're doing. And if you can do that, you're going to get a higher grade. Like it's just, that's how it's going to work. You got to think your prof is reading literally hundreds of these. Jack, if your work is impossible to follow, they're only going to spend so much time before they just give up. That's why you want it to look something like what I have here. Albeit my handwriting's maybe not the best. It's very clear what I'm doing. It's very clear the calculations. This is what I want it to look like. Zaina?
When I was doing my calculation for the food, I just added up the total guess and then times that by the fixed price of 36, and I got the same number. So is that just a coincidence?
Yes, that is, you got lucky.
Yeah. Okay.
Because the reason why Zaina is 5 times 0.2 is 1.
Yeah.
So
okay, but you need to
just got
show.
very lucky in that scenario there. That because if either of those numbers were different, your calculation wouldn't work. So in that scenario, yeah, that's kind of funny actually. It's quite funny. All right, any questions about the inflows, or does that make sense? On your exam, take both sides of the paper. Please do not try to squish everything into as small of space as possible. Take space. Add white space. To be honest, if my iPad could go bigger, I would rather this be like way wider so I have more space. Much easier. So the reason why it was multiplied by 4 to begin with for these ones up here is because these already had existing wine sales. They've already sold those to different people who are going for just the tasting. So for that, when we got the bigger facility, we were only adding really 4 times as many people because we would have had the existing guests already. For the restaurant, we multiplied that one times 5 because we've never operated a restaurant before. It's something that is totally new, and thus all of it meets the criteria of different. That's why the first is multiplied times 4 and the restaurant is multiplied times 5. David?
So yeah, so do you recommend doing this across 2 pages, you said?
Definitely.
Like in the, okay, thank you.
In general, David, take as much space as you need anywhere possible. I don't want to see like a wall of text. It just makes it so much harder to read versus if it's like laid out, subheading, spacing. These are the little things that make a difference. All right, what should the wine tasting COGS be? What should that number be? Maybe you guys can put it in the chat. I'll give everyone else a second to try to maybe fix their numbers if it's a bit off. All right, Carson, I like the number that you put down there. Can you tell me how you got that?
I just took the wine tasting sales number that we got 383,310 and times it by 0.35 because we're given the gross margin of sorry, I read the case. It's the opposite of 0.3, 0.65. 65% I think was our gross margin. So that's how much we're making. So the opposite is COGS.
Absolutely. So our wine has a margin of 65%. That's just like a little extra tricky thing I threw in. Because your cost of goods sold is 1 minus your gross margin. So you're really multiplying this times 1 minus the 0.65 to get your cost of goods sold, which in this case was $134,159. Carson, I saw you put 0.50. You could just round that up. Just round to the nearest dollar one way or the other. Ava, I also saw you put that same number. Good job. These are the little details. These are the little things they do to try to see, do you know your accounting? Gross margin is a function of cost of goods sold. 1 minus your COGS is equal to your gross margin. So, in that scenario here, that's why it's 0.35 is your cost of goods sold. Because if you were to solve this as 1 minus X is equal to 0.65, your X is 0.35. That is your cost of goods sold. For our wine purchases, that one we're just going to do our number that we got above for the wine purchases, which was $280,084. And this one, it said it had a 50% margin, so we can just multiply it times 0.5. And that means for that, our margin was, or the cost was $140,042. What were the utilities and the insurance going to be for these options? Yeah, Alexa?
It said that there was an additional $2,500 for utilities per year, and the insurance increased to $200 per month. So I guess then it would be 200 times 12.
Exactly. Anytime that there's a calculation, I'm showing my work here. I'm always showing the calculation. However, when something's given in the case for your assumption, you can just write given, and that's the logic that you're using to develop your number. What should my cost of goods sold be for the food? What should I put for that formula there? Anish?
It goes 30%. What is it? Food costs. So then you just have the revenue for food multiplied by, what would it be? Is it 70? Oh no, sorry, just a 30%. Yeah.
Times 30%. Yeah. 'Cause I had,
The COGS, yeah.
Exactly. Now this doesn't exist for just the production facility, so you can put like a blank there. It's only for the one on the right, which is the restaurant. And so the food purchase COGS were $108,032. I think if you guys look at the chat for a second, that's a good example of what I was talking about with the commas and the formatting. If you look at Carson's answer, it's like, I mean, my brain works, it's kind of in accounting. I read that number immediately as 134,000 because I see the comma and I see 3 numbers after. Ava, when I see your number of all 6 digits together, you're just making me do a little bit of extra work in my head for me to figure out what that is. Format those numbers better. So it could just be 134,000, 159 like that, or 134. But what I don't like to see is a number that looks like this. Because when I see something all together, you're just making me do a little bit extra work. These are the little details in formatting that make a difference on your exam. Honestly, in the working world, like, details matter. We care about these little things. Want to see proper formatting. All right, what were the chef salaries? What was that going to add up to a year? Dylan, how do you get 90,000?
It's just given the case your like main chef is 55,000 to create the menu and manage operations, and then your sous chef is another 35,000.
I like it.
Could you also just put your server wages in with your chef salary?
Yeah, so you could do that. I think it's better to separate these things out in general just to make it more clear. But you could also put your server salaries in there. That was, what was it? 49,640. So my total outflows for the first option of just the new production facility was $279,101. And if I also add the restaurant, that then takes a decent jump up to $526,773. Your net cash flow is your total inflows minus your outflows. So for just the new production facility, the net cash flow is $384,000. 293. And then over here, if we also have the restaurant, that bumps up to $526,000 and 773. When you're marking a total, you like to put the double underline. The double underline shows that there's no more calculations. That's your finished calculation. Again, we're getting back to the little details about the formatting. These things matter as you go into this course, into Ivy, into the working world. You want to have correct formatting. David?
I remember my teacher explaining in class, I'm just a little confused still. So the additional expenses, like as a percent of sales on the income statement, we have additional sales. So how come those additional, like those expenses that increase with our additional sales aren't included on the net outflows?
Could you get a little bit more specific, David?
Like on the income statement, you have like advertising, for example, as a percentage of sales. And because we have additional sales, I was just a little confused why those, like advertising would increase with those additional sales. So why those aren't included on the.
It's got to meet the criteria of different, and in the specific part where it was talking about your differential analysis, it didn't say anything that they would be paying additional advertising with this.
Oh, I see.
I think you could question it in your analysis saying, hey, I think if we added this new facility, we would also have additional marketing and advertising. However, in the actual case, it didn't say anything about them spending more money on this. So that's why in this scenario here, we wouldn't be adding that in because it doesn't meet the criteria of being different.
I see. Okay. Thank you.
Good question. All right. Any other questions about our inflows and our outflows to get the net cash flows we had here of 279,000 and 526? Yeah, Mila?
Did you make the assumption that the same amount of people from each tier are going to purchase bottles, or like how did you at the beginning?
Yeah, I made the assumption that it was going to be the same amount for each tier. That's something that you could challenge in your qualitative analysis in a minute from now of these numbers.
Okay, also I'm a bit confused about waiving the tasting fee if it's like the $40 tier and if the bottle's cheaper than the tasting fee. Then like
another good thing that you could challenge in your analysis as well. I actually never even thought about that because that's like a net loss for them if they're waiving a $40 fee for a $28 bottle. I think you might have identified a bit of an issue in the case. Good point.
Wait, are they buying a premium bottle or just the like anything?
I think we said that the average price was $28 for a bottle, but yeah, you're right, Anish.
They try like 4 premium wines, right?
So maybe they could be buying a premium bottle that has a higher price, like $60. That could be the idea too.
That I don't know.
yeah, I kind of assumed when it said $28, I thought it was like the millennials were buying the bottles because that's their price.
Good point. And I think, Mila, what you're getting at is every case you're going to read something that you're not fully sure what to do. That's why having this assumption column in the middle and you're backing up the logic that you came up with for your decision. But based on what you said, I mean, I agree with what you said. Zaina?
Could you please scroll down to your net cash flow numbers?
Yeah.
If it's inflows minus outflows for with the restaurant, would it not be the exact same? It's 526, 773.
Sorry, I was looking at the wrong number there. You're absolutely correct. I wonder if my other number's off too. No, my other one's correct.
No, your other one's good. I think you just wrote down the wrong number.
Yeah. Thank you very much.
No problem.
Okay, good point. Rock, I want to go back to what you said earlier where your numbers looked off. your net cash flow here is almost always going to be greater than zero every time. Why is that the case? Why is our net cash flow here always going to be greater than zero?
Well, because then it's like you have negative like ROI and like payback, and you guys just wanted to give us a situation. Like I knew it was wrong, I just couldn't really figure out why until now.
So that's the idea. If you get a negative net cash flow, you're like, wait, why would we be going forward with this future opportunity if we think that we're going to be losing money willingly? Like that doesn't make sense. Then you would probably go through and say, oh wait, I'm only going to be making the investment into the facility once. It's not a differential outflow. Instead, it's a differential investment. Maddie, great question. So why don't we have to do a status quo column or status quo column? It doesn't meet the criteria of different. Everything in the status quo they would already be doing. So again, it doesn't meet that idea of different. You could choose that as your answer, and in your projected statements, it'll all be the same. But for your differential analysis, it doesn't meet the criteria of being different. This is the level of difficulty I would expect for your exam. Like what I did up here with the 25% conversion and the multiply by 4, that's a little bit tricky. That's intentional. Your exam's not going to be easy. They try to give a few of these little things. Hopefully you're starting to pick up on them moving forward. All right. What should the calculation for the new building be for the new winery, and then after for the restaurant? Can someone tell me that? Yeah, Jack?
Yeah, so I don't know if I'm fully correct here, but I did 10,000 square feet, which is the size of the building, and then multiplied it by $380. And then
And what did you do for the other one?
I added $70 to that 380, so it was 450.
And what number did you get in total for the new winery, or for the new winery plus the restaurant?
So with the restaurant, I got 4,500,000, and then without the restaurant, I got 3.8 million.
Does that sound like a realistic number, Jack, for building a huge new facility? Like, does that sound within the realm of reason?
Yeah, so if you're built, obviously, like the higher number for the restaurant makes sense because there's going to be kind of more stuff that like you're gonna have to consider. So yeah, I think it's a pretty reasonable number for a building in British Columbia too. It might be a little bit more expensive.
Absolutely. You always want to be asking yourself, does this make sense? Does this seem reasonable? These net new cash flows, this seems reasonable that you're going to be making roughly 380K more a year or roughly 500K more a year. When we think of the investment cost for a new building, 3.8 or $4.5 million makes sense. This is a huge new facility, more capacity, more space. They're building it from zero. Always ask yourself, does this fit within the realm of reason? All right. Yeah, Maddie?
I was just wondering, like, as you're talking through that, would you want us on the test to write like a little blurb of why like that makes sense and like why those numbers make sense?
No, that's just for you internally to be like, oh, am I way off? Because like if you put like, say you forgot a zero and you got $380,000 here, you'd be like $380,000 to build a huge new production facility in British Columbia with everything that's going on. That doesn't seem realistic.
Totally. Thank you.
All right, the fixtures for just the new winery was given at 15K. And then for the restaurant, I believe it was 5,000 more at 20K. Notice how I'm using two different colors. I mean, do you have to do this on your exam? No, but I think it just makes it a little bit easier to follow along with the work. At the end of the day, you're trying to make it as easy to understand as possible. The moving expense stayed the same as 10,000 for each option. Can you guys help me understand that sentence that I just said? I said the moving expense stays at 10,000. But if it's an expense, why do I have it in my investments and not above in my differential outflows? Jess?
Would it be because it's only one time?
It's only one time. You always want to ask yourself the logic, is what I'm doing making sense? All right, inventory. What's going on with inventory? What do we have to do for that? Yeah, Jack?
Yeah, so I think you take your differential COGS and divide that by 360 and then multiply it by your days.
When you say differential COGS, what do you mean?
Like the COGS in your outflows?
For everything or just some?
I did 4. Wait, sorry, let me just check.
What number did you get, Jack?
My numbers were all a little messed up just because I multiplied it by 5, but I did the sum of the COGS for my first, like for the addition. I just did the sum of the number. Like I did both of them. Sorry.
I'm trying to find the exact wording in the case. Did anyone do something a little bit different than Jack? We're not talking about the food inventory right here. We're just talking about the wine. So there's no investment for food inventory because it said food raw materials were purchased from a local Kelowna supplier which had credit terms of 20 days. Food would be purchased daily and would not require an initial investment to begin operations. The couple also estimated that they would need to hold wine inventory on hand to ensure they could meet customer demand. Susan estimated that 60 days of inventory would be suffice to handle all customer requests. So for Jack, what I did for this is I did my wine purchase COGS divided by 360 times 60 days. So I didn't do all my COGS, just the wine purchase COGS. So I did the $140,042 divided by 360 days times 60 days. So that got me 23,340. Yeah, David?
Yeah, I was just a little confused as to why. I don't know if just maybe I missed something with the wording, but for the COGS for the wine tasting, like there's still bottles included in that. Where would that be included? Because the purchases wouldn't include those. That's what I was a little confused about.
Yeah, so I mean, I see your point. 100%. I think in future cases, they might even have to make it more specific. Like I could see you doing what Jack did. I could see you doing what I did. I think as long as you're backing it up with your assumptions, to be honest, I would probably accept both.
Okay, thank you.
I think as you're seeing, these cases are never perfect. Even the ones on your exam are never perfect. Like even IB exams are not perfect. Sometimes you just have to make your best guess. Ask yourself, like, does this make sense? And then put it forward, but it's not going to be perfect every time. Accounts payable. Can someone help me understand what's going on with AP? This one's a bit more straightforward. So with AP, it says food raw materials were purchased from a local Kelowna supplier, which had credit terms of 20 days. So what we're gonna do for that is we're gonna take our food purchase COGS, which was $108,000 and $332. We're gonna divide that by 360 days and multiply it by 30 days. Should this be a positive number or a negative number, and why? Negative. Why negative, Ashley?
Because it's a disinvestment.
Why is it a disinvestment?
Because it's a liability.
Keep going.
Because it's a liability.
So with accounts payable, remember accounts payable is a source of cash. We don't have to pay it back for 20 days. Because we don't have to pay it back for 20 days, that's 20 days source of cash for us. That's reducing the amount of investment that we need at the beginning. That's a good thing for us. That's going to be treated as a disinvestment. So our total investments for just the new restaurant was $3,848,340. And if we add the restaurant as well, then that's going to go up to $4,547,338. Few questions, I guess. Why is there no AP for option one? Because the AP is only for food COGS, not for wine. What about the one-time consultant fee? Dylan, that doesn't meet the criteria of being future. They've already paid it. That's a sunk cost. So if something's a sunk cost, you do not include it. They've already paid that person to help them. Sorry, Zaina, you're correcting my mistakes. That should be 20 days. Thank you. Attention to detail. So, $3.8 million investment for a net cash flow of $384,000 makes sense. And a $4.54 million investment for $496,000 in cash flow also makes sense to me. These all fit within the realm of reason. Yeah, that's correct, Rock. If they do not mention anything about inventory or AP, we would not include it. And same thing, Carson, we only do AR if the case mentions. In this case, we sell everything right away, so that's why there's no AR. Then we're going to calculate our ROI and a payback. So our ROI for the restaurant option is exactly 10%, or sorry, the new production facility is 10%, with the payback being exactly 10 years. And it's a little bit better with the restaurant at 10.9%. and 9.15 years. Yeah, Rock?
One question I had about just like when you're kind of reading through the actual section on differentials for the case, like what I did was like I read through that section, and then on like the side on the like spare notes section, I wrote out like almost like my assumptions. For example, like it said like fixtures cost like 5K or something like that, or COGS are gonna be like 30% of the XYZ number. I just wrote that on the side, and then I kind of used it as a bank to go back into my calculations. Just in terms of like time and like overall effective strategy that you would use, would you just kind of read through the case line by line, then do your investments calculations like what you're doing right now? Or would you recommend writing out all the assumptions on the side and then looking at from there?
When you say on the side, do you mean the side of like the actual case, or do you mean the side of your workbook?
Like on the side of my workbook, I just write out like they mentioned this is going to be XYZ, this is going to be XYZ. But thing is that I got to read it, use those numbers, put on the side, and then go back and do all the calculations.
So what I would do if I were you is I would do something the way I'm doing it. So what I do is when I'm reading my case, I highlight all the things I need my numbers for. And then when I get to actually doing my differential, I lay it out the way that I did here, where in the middle I have this like calculation or assumptions column where I'm showing everything. And that's where I'm showing my prof how I'm getting all of my numbers. So I would do it pretty much the way that I have it right here.
Do you still read it through like the first time and then kind of go back and highlight those numbers, or you're highlighting them as you're reading?
So I was highlighting them as I'm reading it. So you can see I have all these circles all over my page. Those are for all the specific numbers that I know I'm gonna need to use later.
Okay, that makes sense. Yeah, thank you.
Is payback units always in years? Yes. If it's less than a year, it'll come up as a fraction like 0.2. And if it's 0.2, then what's that? That's like, I guess 12 months times 0.2, so 2.5 months, something like that. Not in Dicor, that was in Cool Moose Creamery because it was like just the summer. But to be honest, that's a little bit weird. Normally it's always on a yearly basis. All right, any questions specifically about the calculations that we did here, or does that? Yes.
Or okay, that's always okay. Because I've been like, I don't know why, always been putting in outflows. I think that's just like what my brain's been going to. But it's all
because the outflow there, Alexis, is the actual cost of what you're buying. So that's the food COGS here.
okay. Yeah, I get what you
And
mean.
the AP is the idea that we actually don't pay that until 20 days later.
Got it. Okay, that makes sense. Thank you.
Yeah, Jess?
My prof, whenever we do differential analysis, he keeps talking about like performing sensitivity. Is this something we should always be doing? How would we know to perform sensitivity? Like, what does that look like?
This is where my answer is a little bit tricky. If you're an A+ student and you can crush through these numbers fast, then you can start applying some of your guesses or saying, hey, what if it's not ×4 guess? What if it's actually ×2 guess? Long time to recalculate these numbers. I would not expect you to have to recalculate them all, but when you're doing your analysis, you could say, well, what happens if my differential inflows were to drop by like half? Well, in that case, your net cash flow would decrease a lot, your payback would go up, your ROI would go down. So I think if you're not like amazing with numbers, do it qualitatively. I think if you crush the first 2 exams, numbers are your thing, you might have time to do sensitivity. You could start playing with some of these assumptions. However, I'm very cautious to say I want everyone here to do that, because I think if I said that, a lot of people wouldn't have time to do the projections and thus finish the exam. So I'm a little bit cautious with that answer. I think if you're really good with numbers, that's something you can do to go above and beyond. However, I wouldn't say it's necessarily expected of you because it just takes a long time. Does that make sense, Jess?
Yeah, thank you.
Zaina?
Keeping with your example of like if we were to perform sensitivity on it being 2 guess instead of 4, is that something where we can bring in more qualitative stuff and be like, because this is a COVID year, it's realistic to have less guess? And then would that also like strengthen our analysis?
Exactly. So on that idea, Zaina, every time after you calculate your ROI or payback and these numbers, you're then gonna write out probably like, I don't know, 4 or 5 main points about what you think of this. So what do we think, guys? What are some pieces of analysis that we could create when we see these end numbers over here? Jivan?
They said they had another investment opportunity that would return 10%, and that's really close to both of these. And then also when you look at the total investments, we're investing 3.8 million and 4.5 million dollars. Like, do we have the confidence that we can find that sort of like financing? Because I'm pretty sure the investors, they gave in, I think it was like $500,000 worth of equity. So we would need it, like, for example, for a restaurant, we need 9 times that. So could we find that?
Yes. However, if I'm gonna rebuttal against that point, I would say that our interest coverage was really strong, that we don't have a lot of debt on our books, and if we're going forward to get a loan to build this facility, we could probably use the facility as collateral against that loan, just as our points to try to like increase the likelihood of getting it. So yes, it is a lot of money, but remember, it's a long-term use of cash, probably going to secure it with a long-term source of cash as well. David?
Are these more like general points and then you go more in depth when you come to your decision?
Yeah.
Okay, thank you.
Jack?
Yeah, another factor which I kind of weighed in was the useful life of the building, which they said was 25 years. So that means we're getting have 15 years of generating a profit, which is also pretty appealing. So I think, yeah, looking at that useful life of whatever asset you purchase is a massive factor. And as well, we're slightly above or meeting the hurdle rate. And we're following our goals. So I think it's a pretty good investment.
And when you go back to that idea of goals, Jack, this company or these founders, they're trying to create legacy more than anything. And so for them to have a brand new production facility long term is probably pretty appealing for that specific point there. Any questions about like how to analyze this or what for to do? So Callie, that's a very valid point. I think they are highly inflated and therefore not as attractive. We are expanding cap to 5x more, and I think we are assuming we are operating at 100%, which I don't think is realistic during COVID. So I think there's 2 ideas there. I think 5x is a very high assumption. To assume that you're gonna have 5 times as many people as the existing is a lot. The 100% operational, that's a little bit harder to say. We don't really know with COVID. However, like Jack said, this building is going to be a long time asset. It's going to have a useful life of at least 25 years, probably longer in reality. And so that might be a mitigation to the idea that even if we're not at those full numbers yet, in the near future, we might be. Jivan?
Let's just say we're doing a case similar to this, and we have a healthy company with very low debt. What would you say is like a total investment range which would be like unreasonable?
It's a hard question because there's so many factors in that. It's like, what's your net cash flow? What is your financial health and ratios? What is your investment? What are you investing in? I think going back to what I said, this is a long-term use of cash. We're building a building. So our source of cash is also going to be a long-term source of cash. That makes me feel a little bit better about it, but that's a little bit of a hard thing to say, I think, in general.
So like, would you say like, for example, if we're buying a building that has, let's say, a useful life of like 10 years and we're making the same investment, would you say that's not very good because we're paying it back at the same rate?
Exactly. So in this case, like the hurdle rate of ROI of 10% to 10%, we're like just meeting it. We're barely meeting their hurdle rate. However, when we look at their payback and compare it to the asset that we're going to be getting, which is the new facility, then it looks a little bit better in that sense. So you're kind of balancing those 2 things.
Okay, thank you.
Can you explain ROI means exactly what an A+ analysis of ROI entails? ROI just means return on investment. So for every dollar you put in, they get 10 cents back. In terms of what's a good analysis of it, I think you could talk a little bit about what you said, Callie, where you're highlighting, is this realistic? Is our ROI maybe gonna actually be a little bit lower? Would we actually be getting 5x the amount of customers, or do we think that's inflated? If we think that's inflated, our ROI might drop to like 5 to 6, 7%. And then we have to ask ourselves, are we still okay with that if their sales figures aren't as good as we're expecting them to be? David?
Yeah, just quickly for this case, let's say we were below like 8% ROI, can you still argue because of the legacy and like the name, it helps become more established that the restaurant brings us, it's still worth it?
I think so. I think you'd have to really make a good argument, but I think you could.
Okay.
Paige, I see that question about AP. Let's stick around at the very end today and go back to that. Rock?
Kind of going back to the question just answered earlier, what sort of things should we be talking about in like the payback section to get like the A range grades? And should you mostly be talking about ROI and payback and the differentials and like your actual analysis?
Yeah, so you're talking about the ROI, you're talking about the payback, you're talking about how this fits with the company's goals, you're talking about how this maybe helps us better compete with the competitors. You're really going back to that idea of the spider web. Think of like your consumer analysis like this, your competitor analysis like this, industry, corporate capabilities, statement of cash flows, ratios, differential, ROI, and payback. You're making all of these connections all throughout the exam so that everything's complete. That's the way that I think about it. All right. Let's see. Let me just create a quick poll. What you guys all want to do. All right, what should we do? Status quo, new production facility, new production plus restaurant. Still a few more people that need to. Interesting, I wasn't expecting this to be so one-sided. So, as you guys see, there's a bit of a mix of what people want to do. 10% of people said status quo, 17% of people said new production facilities, 71% said new production and restaurant. I don't think there's a right or wrong answer here. I think you could argue any of these three things, which I was very intentional in the way that I wrote this case, where I wanted people to come up with different answers. I didn't want everyone to say the same thing. I think there's pros and cons to each one of these things as people have outlined, so maybe we could get into how to create an effective decision and what that should look like. But as we see here, different people have different answers, which is rather interesting. This is how I like to lay out my decisions. You are not writing like a mystery thriller book here. You're writing a case analysis to what financial decision you do. You're not building up suspense of what your decision is. You're saying immediately, I decide to go forward and build the new production facility and finance it with a bank loan. I decide now is not the right time to do a big investment. I will continue with the status quo. I decide to go with the restaurant and I'm going to finance it with equity or debt, whatever it is. Say your decision at the beginning. Then the way that I like for you to structure this is have 1 to 2 qualitative points mainly. No, not even 1, like 2 to 3. And then also 2 to 3 quantitative points that are going to support your answer. Why don't we hear someone from each category? Someone that wanted to do the status quo. What were the reasons why you wanted to do the status quo? Anish, did you want to do the status quo?
Nah, I did not. That's why I took it down.
Okay, I'll come back. What did you want to do, Anish?
I wanted to do the restaurant and the production.
Okay, we'll come back to you. You can think about your points in the next few minutes. Who wants to do the status quo? What were the reasons why? All right, maybe just whatever your decision. Jivan, did you want to do the status quo?
Yeah, I didn't put it down, but I think I could come up with an argument for it.
Nice. What is it?
So qualitatively, people have stated before COVID, we don't know if these numbers will be exactly what we think they are, like 5 times, 4 times. We're not sure if we could reach that. Also the wine itself, like how long it's sitting. When we're getting this new production facility and restaurant, how long is our wine now going to be sitting in that large production facility? Because I think it's like 4 times as large as our previous production facility, like smaller production facility. And then quantitatively, it's 10% return on our investment, which we could reach with the other investment. And we don't know exactly what that other investment opportunity is, but it might be safer considering like COVID. So it might be easier to reach considering the numbers that we've given I think are quite generous. And off the top of my head, I can't think of another quantitative one, but
I like it so far. I think adding on to what you said, Jivan, we could also say, do we even know these investment numbers are like realistic? A lot of times in construction, projects go over time and over budget. And we're already right around that hurdle rate of 10%. If these things continue beyond that, what does it look like? And then I'm just looking at our balance sheet from last year. We only had 1.1 mil of assets. We're going to be like 4xing that in the future. Is now the time to do that investment given what's going on in COVID? I think are all very valid points. I could see you getting an A with going with the status quo option. The new production facility, does anyone want to provide their arguments for just the new production facility? Yeah, Abby.
Okay, so obviously the numbers for just the new facility aren't like a crazy difference from the restaurant, so I kind of base it more off like a qualitative perspective, just because the restaurant industry is really has really low margins and is really risky to enter, specifically because we have no experience in that industry. I think sticking with just the new facility, sticking to wine for now, and then maybe in the future, if that is like the new facility is really successful, adding on a restaurant.
Absolutely. So you're focused on the qualitative factors there. I think you could really get into that idea that like 80% of restaurants shut down within 5 years. And then couple that with the fact that we're right in the midst of COVID, how could future restrictions maybe affect that? I think qualitatively that all makes sense. Quantitatively, you're right. The numbers are rather similar and the difference in net cash flow is kind of offset by the difference in the investment. So your main differentiator is the qualitative factors there, which I think makes sense. Anish, what were your reasons for the, actually, I'll come back to you in a second. Alexis?
Oh, I just had like kind of a point that I was kind of thinking about our competitors as well, like on the qualitative side, that other places like there's Martin's Lane. I don't know, there's a couple other places, sorry, I don't have the names on top of my head, that are really exclusive and are already excelling in the restaurant industry. And it's like, I think our factor for trying to go again back to the goals, kind of like for this fun energy, these younger consumers are not probably going to want to pay for a dinner. Like that's maybe part of their aspect, but that's not really in their budget range. And as well, like I think that we shouldn't really be taking on like from like the quantitative side, like extra employees. Like, I mean, I know we're gonna have extra employees anyways, but we're getting a chef and a server that, I mean, their wages aren't crazy, but given how much we're already spending on wages and salaries, I don't think it's maybe something that we should be taking on. And yes, it's only 10% to 10.9, but I think given all of the factors, I think starting off with this, exactly kind of what Abby said, from like this to that, like I think we can always jump there if they decide to.
Absolutely. And I think, Alexis, what you could do to make that stronger is get specific with the wages and saying you're adding roughly, what, $140,000 in wages between the chef, the sous chef, and the servers. And you could even go a step further and say that might actually be on the low end. That doesn't sound very high to me for 4 people's salaries. So maybe that's actually understated. Anish, what were your arguments for the restaurant?
Okay, so I said like these two, like whatever, Mr. and Mrs. Smith or whatever, I don't know, like yeah, Mr. and Mrs. Smith, like they want to build a legacy for the company long term, and they can stay small and stay wherever they're at, be stagnant, but it's not like really following like their long term vision. Like they already have money. That's not really the main concern here.
Absolutely.
So obviously they want to be financially healthy, not bleeding, but building their family legacy, creating a better experience for their current customers, growing the capacity of people that they can get. They can have like a lot more fun in a better place, not inside their house, more professional, and just a better experience for their customers. And then quantitatively, a 10% return, we can say that the other thing is going to give them a 10% return. First of all, we don't know how safe that 10% return is, how guaranteed it is, what the risk is. And 10% return is great. If we can match a 10% return and then we have control over everything that goes on, that's honestly a great choice. And even in the case, it's, let's say, instead of like whatever, 10.9 with the restaurant, say it's like 8%. So we're losing 3%, even 7%, that's still a great return in the market. And assuming the production doesn't perform, the restaurant doesn't perform, 8% is great. And also they have like a $4.5 million property built. So like worse comes to worse, they lose all their Saks money, they lose like everything, and they just have to sell this winery. They now have a $4.5 million property. Of just the building on top of it. So I think it's like the only way to go here.
Is the restaurant.
Yeah.
Interesting. So I think, again, there's fair arguments for everything here. Like when I wrote this case, I purposely wrote a case that I wanted people to go with different options, because I think, you know, if it's so obvious that it's one of the choices, it's not a particularly well-written case. You know, people should go different ways. And based on Abby, your arguments, I agree. Anish, based on your arguments, I also agree. They're different arguments, they're different decisions. It's all about how you back it up. There's not a right or wrong answer here. If there's a right or wrong answer, I mean, we'd all be the richest people in the world, but it's not necessarily the case. Jess?
Could we say like, yes, we do want to go with the restaurant and expansion, even though a pro is a restaurant, can we counter that pro with a con, such as like, we think in the future, if we do go with this option, maybe a fixed menu is not the right choice. But can we say those cons here in the context?
Absolutely. So I think you could even challenge it or say like, right now, I just want to go with the new production facility. If we see that it's heavily successful, maybe we can invest in some like pizza ovens or something in the future that would be much easier and a lower investment, but could still satisfy that idea of offering food. I wouldn't go too crazy out of the realm of reason with offering alternative solutions, but that's something you could talk about in your action plan when you're thinking of like your long-term items. If I was doing this case, I would go for the new production facility. I don't think I would bother with the restaurant. I think the restaurant industry is a little bit too risky for me. I also think that assuming that like 20% of people are gonna stay and pay the $36 might be high. And I think it's also just another additional headache for them to add while they're also building out a new facility. So if it's me, I don't think I would put that additional 700K into the restaurant right away. I might leave that for a few years down the road. But I see the arguments of people that did, and I don't think there's a right and wrong answer here. All right, any questions about the decision, or does this make sense? Again, the way I would like to see this is I decide to go with the restaurant. Point number 1 allows us to compete with competitors, get into it. Point number 2 fits better with what our consumers want. Point number 3 helps us solidify our legacy. And then as well below, quantitatively, I would probably get into the net cash flow that we're adding, how we beat our hurdle rate, and I think that's sufficient for the quantitative. Jack?
Do we need to have like, can we just put this in dot shots? Like I decide to for the following reason, then you can just say like surpasses hurdle rate, like that, or do you need to have an implication with it as well?
So I would have the title being like, I decide to go with the restaurant. I would then say surpass hurdle rate, and then below it, I would explain why I think that's a good thing and why I think that's reasonable. So you don't just want to have your dot points, you want to keep going.
Okay.
Rock?
Are we supposed to mention here like the form of financing that we're gonna use?
Yes, you also have to say what financing you're going to use. That'll be in the quantitative. And I think for this answer, I would 100% go with debt financing. They have a strong interest coverage. They have almost no debt on their books, and they're buying a build, or they're building a building, which is a long-term use of cash. We could try to secure the loan against the building that we're building with it.
What would be like your basis of evidence or like looking at things beside like the interest coverage and like debt to equity ratio and whatnot? Like kind of like your piece of evidence for that.
Yeah, I think the evidence would be that we just paid off a massive loan of $500,000 last year. Our balance sheet only has 20% debt right now, so we're not highly leveraged. And again, we're using this as a long-term use of cash, which is a building, and we want to fund that with a long-term source of cash from the bank. As well, the the founders have a lot of success. They've built businesses in the past. I don't think they would have an issue getting financing. Yeah, David?
I guess just the spider web example you're talking about again, I guess every general point you state, you just want to relate back to something relevant you've previously analyzed?
Exactly.
All right.
And I think that's the analogy you want to use for everything here. A lot of people are asking like, how do I make a good standout answer? Like, what should I connect it to? We're not robots, we're not machines. Everyone's gonna have different ideas. I can't tell you guys like always do this or always do that. It depends on the case and how you're formulating your ideas. But I think David, like you said, having that spider web of you're always connecting something to something else is the right way to think about it. Mila?
If we do the status quo, should we say if they did decide to still move forward, they should use debt or equity, or would that not be important? No.
Not important, because if you're just doing the status quo, you keep going, and then you don't need any financing.
Okay.
Could you explain pros and cons of debt versus equity? Let's ask that question at the end, because that's, again, not such a simple answer. Anish?
Okay, just to confirm, so the 2 to 3 qualitative points, 2 to 3 quantitative points. If we're doing anything with financing, we need to if we can't miss talking about the financing on how it needs to be there, we put our bullet points and then we keep asking why the points, similar to everything else that we've done.
Exactly. So your bullet point, based on what you said, Anish, would be like building will cement legacy. And then below it, that's where you get into the idea being like, these guys care more about than just money. They're trying to build something on the land that their family's been on forever. If they're investing into this brand new facility, it's going to help achieve that goal. And you're explaining that like one sentence header that you have with your implications below it.
Okay.
All right. Your decision, I would say, should be about at least a page, maybe a page and a half, 2 pages. I think in general, there's always stuff to write here, and the good exams really get into the details versus the not so good exams have a very high level. All right, are we good? Should we go to the projected statements? I see that there's still a few questions we haven't answered. As always, I'm happy to stay around until the end to answer them. Risk and mitigation, we'll talk about that at the very end, David. So that's after the projected statements. So at this point in your framework, you've already made your decision. You know what you're doing. You're now going to reflect that on your projected statement. You guys want me to just do the projected statements? Or do you want to participate? I'll take the lack of answers as I'll just do it. Let me just make sure I can have the chat. Do we write the analysis double spaced? No, you can write your analysis like line after line, but in between your analysis points, give spacing there. That helps a lot. All right, so existing revenue, let me get my notes. You guys care what option I do the projected statement for? All right, I'm gonna do it for the winery and for just the new facility, for building the new facility, but not the new restaurant. So for revenue, existing revenue is equal to last year's revenue times 1 plus a 20% growth rate. And that value was 1,534,660. Differential inflows is equal to your total inflows divided by 12 months times 2 months, because they're only going to have 2 months for this year. So that was $110,566. Your total revenues is just the sum of those two. Jessica?
Where are you finding this 2 months from?
So it said in the case, if they went forward with this, I think it would be completed at the end of October. And so that means they would only see this for November and December. They would only have this for 2 months in the year.
Thank you.
Existing COGS were given as 43% of sales. So for that, I would just take my existing revenue times 0.43. And then my differential COGS, I could take from my differential, which was, I guess it was your wine tasting COGS, which was $134,159, plus your wine purchase COGS, which was $140,042, divided by 12 times 2 months. My gross profit is $936,622. Seems reasonable. Seems within the realm of reason. My wages and benefits were given as 20% of sales. I'm going to use that as 20% of existing sales because we already added the additional COGS for the other stuff. So I'll just take my existing revenue times 0.2. My depreciation old was given as $30,000. My depreciation new will be the building, which was $3,800,000, divided by 25 years, divided by 12 months, times 2 months, plus my fixtures, which was 15,000, divided by 10 years, divided by 12 months, times 2 months. Decent amount going on with this one. So that added up to $120,817. Advertising and promo was a 20% increase from the previous year. So that added up to 120,800. Oh wait, sorry, I took the wrong number for the depreciation now. That's 25,817. No, 25,580. So the new depreciation is coming from a few different things. Part of it is the new building that we got that was $3.8 million. That building was being depreciated over 25 years, but because we only have it for 2 of the 12 months this year, that's why you also have to multiply it by 2 over 12. And then the fixtures were $15,000, and those were depreciated over 10 years, so that's why we did 15,000 divided by 10 years, and then multiplied that by 2 over 12 as well. Bad debt was given as 0. Consulting fees was same dollar. Insurance was same dollar. Is the 20% increase the 2020 advertising cost added by 20%? Yes, it'd be multiplied times 1.2. Insurance was 5,200. Interest and bank charges, I believe, was given as 6,500. Office and miscellaneous was same dollar. Professional fees was same dollar. I think you could maybe question if some of these would actually be realistic because they might have different things. If I make a mistake somewhere in here, please don't kill me. There's a lot of numbers. I'm just trying to copy them down correctly. Repairs and maintenance was a 20% increase. Subscription and permit, same dollar. Telephone, same dollar. Are you able to send the completed projected statements? No, sorry, I do not send anything from these sessions. That's just mainly to protect myself, to be honest. Differential moving expenses was given as 10,000. And then your other remaining differential outflows is from your differential outflows. Was there anything else that we missed? One sec. I guess it'd be the utilities insurance. So the 2,500 plus the 2,400 divided by 12 months times 2 months. So that's equal to 4,900 divided by 12 times 2. Yeah, give me a sec. Your net income before taxes is your gross profit minus your total OPEX. Income tax was given as 15%. And then your net income is just the sum of, or the difference of those. Not bad, 322,000. All right, this is what your projected statement should look like. To be honest, you guys probably all have different numbers than me, but that's okay. It's mainly the process here that matters more than anything. When we're ready to move on to the balance sheet, maybe just send a quick message like ready. or maybe like a thumbs up or something. Yeah, Georgia?
I was confused with this because all of it would say like without the new facility. So when I picked the facility, I was like, oh, well, it shouldn't be these numbers then.
So this is the difference between the status quo. So most of these are status quo items. The ones that are different is like the differential inflows, the depreciation, and the differential COGS. Those are the ones that are being added in addition to this stuff. And those all come from our differential. All right, any other questions? Yeah, Rock?
If they don't say anything like this increase by XYZ or whatnot, is that when you just put the same dollar?
Yeah, well, you'd either do same dollar or same percent. I think that's where you could ask yourself what seems the most realistic. If it changes with volume, go same percent. If it just always stays the same, just put same dollar.
Okay, and then can you explain if you can scroll up a little bit? Or is that, yeah, I think the existing revenue calculation. Can you just explain that one again?
That's just last year's revenue times 1 plus the 20% growth rate. So it's just last year's figure times 1.2.
Okay, because I think what I did was I just took like 20% of the existing revenue and added that on to the previous year's revenue.
That's the same thing as multiplying times 1.2.
Okay, that's good, thank you.
To be honest, it's much easier to just multiply times 1.2 because then your calculation is just a bit easier.
Okay.
All right, any questions about the projected income statement, or does that make sense?
Wait, so are you supposed to comment, like make analysis on this stuff too, or do you do that like once you have the balance sheet?
Once you have the balance sheet as well.
Okay.
What's the net income after tax there? Sorry, can you scroll down a bit?
Yeah, it's $322,246. Not bad, not bad. All right, give me a little thumbs up if you're ready to move to the balance sheet. Give me a thumbs down if you still need a second. All right, let's go to the balance sheet. So, on the balance sheet, cash was just staying as same dollar, which was 41,212. AR was going to be 15 days of projected sales. So what you would do for that was equal to, what was our projected sales? It was 1,534,660 divided by 360 times 60. And that is equal to 63,944. Inventory was 409 days of projected COGS plus differential inventory. So that would be your cost of sales, your existing cost of sales, which was equal to, from your projected statement, the 659,904 divided by 360 times 409 days. Plus your differential inventory. That's equal to $773,064. A lot of wine. Prepaid expense, same dollar. All right, your long-term property, plant, and equipment would be your 2020 net, less your projected depreciation for that. So that's equal to $361,688. Your fixtures would be your, again, this is all showing the net, so it'd just be like your 15,000 less your projected depreciation for the fixtures. So that's equal to 14,750. And then same thing with your building, your 3.8 mil less projected depreciation. And that's equal to 3,774,667. Your total long-term assets is just the sum of that. Same with your current assets. That means our total assets equals the sum of this and this. How do you do projected for property, plant, etc.? I just took the 2020 figure, David, and then I less the $30,000 that we had from last year. So if you go to your balance sheet, on our balance sheet from last year, I believe our net property, plant, and equipment was 391,688. So to get this year's, I just did that minus the 30,000 depreciation that they gave us. So this is total assets. If you went with the restaurant, that value should be, 1 second. That value should be $4,470,000. All right. Any questions about the assets before we move forward to the liabilities and equity? Any questions about these? Current liabilities. Was 27 days of projected COGS. Yeah, Gabby?
I just had a question. Like, when you don't see anything written in the case, you just assume that it's the same?
Yeah.
Sorry, thank you.
Either same dollar, same days, same logic as the previous year. Income taxes payable, that just comes directly from your 2021 projected income tax. Your current portion bank loan is just the same dollar, you pay off the same amount each year. That means your total current liabilities is the sum of everything there. Your long-term liabilities, your bank loan payable would be your 2020 value less your current portion bank loan. That was 95,492. Your plug, we're going to come back to this. Your common stock, same dollar. Shareholder contribution, same dollar. Retained earnings would be last year's retained earnings plus your net income from this year. All right, how do I figure out my plug? Who wants to walk me through how to do this with my plug? Georgia or Ava?
Okay, so you're gonna take the same total assets for your total shareholder and liabilities.
Yeah, so let's go
And then-
equals this equals 5,030,000. Yeah, okay.
And then you'll find your total shareholders equity because you'll minus the total amount from the total liabilities.
The opposite. You'll find your total liabilities. Sorry, I need to actually add a line item here.
Sorry, yeah, you'll find your total liabilities minusing your total shareholders equity.
Exactly. So total liabilities plus shareholders equity minus total shareholders equity. That means we need 3.79 million in total. Okay, what should my total long-term liabilities be then?
So I don't have the amount. I didn't do it properly, but you would just do your total liabilities and then you could minus everything else, I guess.
You'll do your total liabilities minus your current liabilities.
Oh, yeah.
So that means we need to have 3.674 million of total long-term liabilities. So
Yeah.
to figure out our new loan, we just figure out the difference there. So that's the total long-term liabilities minus our bank loan. And that means we need a bank loan of 3.6 million. That makes perfect sense to me. That's almost exactly the amount of the new investment that we're making. This makes sense. My numbers all seem to add up. It's all within the realm of reason. All right, any questions about that? Rock, it's gotta balance because you have a plug figure in there. So if it doesn't balance, you're doing something wrong in your arithmetic, but that's the reason that you have that plug is so that it always balances. Yeah, Ashley?
So in class, we did an example where like it was negative because we had like excess cash. Could you just like go over the logic behind that?
Yeah, so if you get a plug, to be honest, you would never, yeah, Dylan, 1 second. Okay, I think that should see everything. So Ashley, if you just say went with the status quo, then you would put a plug in your like a working capital loan. If you put a plug in your working capital loan and you got a value of like negative 15,000, that means you actually have the cash on hand. You're not gonna bother going through the effort of like redoing it and fixing your balance sheet because that's kind of a waste of time. You're just gonna analyze it qualitatively and say, hey, we have a negative plug. That means we actually don't require any financing. That's a good thing. We don't need any money. Any other questions about the projected income statement or balance sheet? Jess?
Where would the plug go if you were financing through equity?
At the very bottom here, you would add a line item called equity financing infusion. Can we go over the plug calculation? What do we label the plug if it's negative line of credit? Yeah, that's fine. Negative line of credit, that just means like you actually have the money. Can we go over the plug calculation one more time? You're just doing like reverse arithmetic. So you know your total assets has to equal your total liabilities plus shareholders equity. And then you're solving for whatever your unknown X is to make that worthwhile or to figure out what the missing value is. So if your total liabilities plus shareholders equity is 5 million and your total shareholders equity is this amount, that means your liabilities is just the difference. Because again, you're trying to solve your X. And if you know if your total liabilities is this much and you know your current liabilities is X amount, then you're just taking the difference. And then to actually get the plug again, you're just taking the difference. So you're kind of working your way backwards to get there. Where did the 27 days of payable come from? I believe that was given in the case that the payables would be the same days as last year. After you create any statement like this, you're also then expected to analyze it. So when you analyze it, you would say, do you think it's realistic? Do these numbers seem high? Do they seem low? Does it fit with what our goals are? Does it fit with what our competitors are doing? I think you guys are getting the idea. In your analysis, it's like truly open-ended where you can go with the ideas. That's why this exam, every student writes until the very last minute. Doesn't matter how good or bad you are at this course. If you're finishing early, that's probably not a good thing. There's probably more analysis that you could be writing. Each time you're creating one of these statements, there's always like 3 or 4 pieces. Jack?
Yeah, say you like finish a little bit early, like would you recommend going back to all of your analysis and maybe adding a little bit more if you could think of it? Or even if it's not as strong, like would you lose marks for having weak points if you like find more? Or...
So that's sometimes a good idea, Jack, is give yourself a little bit of space in each section if you have a lot of time to go back and beef it up and adding a few more points to it. So I think that's a very, very fair thing to do. How important is the balance sheet? I don't really know how to answer that besides saying it's important. Carson?
I'm not saying I did this. I'm just asking if could you go with an equity infusion, like and like say like back it up with like like they've sold like business in the past and have a lot of like they can obviously run business and they have a lot of money on hand. I guess they paid off their debt already instead of adding another bank loan on top of a bank loan we already have.
I think in this case though, I'd be like, let's take on the debt, man. Let's use that interest to reduce our taxable income. The bank's probably going to say yes, especially because it's a long-term use of cash that we're using it for. So in this case, I would definitely go with debt financing. However, if the financials were a bit weaker, then you could use those backup points of why people would invest in our company.
Okay.
David?
Yeah, so for the balance sheet income statement, for the analysis, are you just kind of ballpark going over some of the bigger numbers and if the plug makes sense, stuff like that?
Exactly.
Okay. All right, thank you.
You're always concerned about the big numbers here. You're not concerned about the small things. You're always concerned about the big case. In this case, would we perform sensitivity? I think the sensitivity is the same answer as before. Like if you're a rock star student and you can crush through these financials, sensitivity is a great thing to do always, but I wouldn't say it's the expectation. Ashley?
So I was wondering, if it says something in the case, like they were hesitant or like thought they couldn't get a bank loan, beside equity fusion, like what else would you recommend we talk about? Like, could you talk about getting like a loan from like a third party lender and like paying some higher interest or?
Yeah, you could. I don't know if we love that idea, but you could. So I think if you're having trouble getting a debt financing option, then maybe equity is probably where you're going. And if you think you're gonna have trouble with both of them, then maybe now is not the time to expand and you should wait until your financing is a little bit more concrete.
Okay, thank you.
Any other questions about the projected statements? What do we think? How are we feeling? How do we feel about things in general? You guys have all turned off your cameras, so I can't really see reactions. You're not making it easy for me. Thank you for like the 6 people that have it on: Mila, Jack, Jivan, Abby, Paige. I challenge you guys to give a presentation online to blank faces and tell me how much fun it is. All right, a few people turn it back on. How are we feeling? Like thumbs up? Are we feeling okay? Thumbs down? We got some work to do? Like where are we at with everything? Fair enough. End of the case when everything piles up. It is hard. It is difficult. I think, again, we'll get into the action plan and talk about a few things in a second from now, but this is kind of your like, I'm good. I've been taking the right approach. Or this is a wake-up call for me. I need to figure out my stuff ASAP. This is the exact level you could expect of an exam. It's long. There's a lot of financials. The financials get tricky. You might not know what to do. You gotta take an assumption and move forward. You can't spend 45 minutes trying to figure out one specific number because that's just not gonna go well. So in general, that's kind of my advice to you is today's a good feedback point for you. If you found yesterday and today made perfect sense, if you were following along for the most part, keep doing what you're doing. If you found that there were major weaknesses, you were really struggling, you're really lost, I'm going to tell you the exam's not going to be so much fun. You got to figure out what part was specifically difficult. So hopefully this was a good feedback overall. In terms of action plan, you're just thinking of like 3 to 4 short-term items, 3 to 4 long-term items. So for example, if my decision was to go through with the production facility, short-term item would be contact the bank manager and set up a meeting to secure the loan. Then contact my whatever contractors and whatever licenses are needed to start construction. Start looking into promoting the new space, reach out to like existing customers, think of everything you need to do to make this happen. In your long-term action plan over the next 1 to 2 years, that's where you're thinking of what might you change. Maybe you could review Google reviews and see what needs to get better. Maybe if things aren't going well, you could look into investing into a restaurant. You're essentially thinking like what would happen in the next year to 2. Contingency plan is kind of just saying like what could go wrong. So for example, maybe the project goes over time and over budget. Maybe we need to allocate an extra security float of like 10, 20%. Maybe another risk is that we don't have enough customers. Maybe our contingency plan to that is like put more money into our marketing budget to get the word out. In general, your action plan, short term, think 3 to 4 items, long term as well, 3 to 4 items. I don't think the action plan is particularly rocket science. You're just thinking like, what do I need to do today? And what would I need to do over the next few years to make this a reality? Yeah, David?
So I'm assuming like the action plan and the analysis of like the income statement and balance sheet, they're not weighed as much as the initial analysis of like the statement of cash flows and industry and stuff like that.
Yeah,
Okay.
I think that's a fair assumption.
Okay.
Jess?
What goes into a promotional plan if we were to have to make one at the end here?
Anyone that's worked with me throughout the years knows that I fucking hate marketing. It's definitely not what I'm good at. I would never put a marketing plan on this exam because I'm like, this is a fucking accounting course. If you had a marketing plan, I don't really know. You probably know as best as I do. Rock?
With the action plan and contingency, or I know you mentioned 3 short-term, 3 long-term. Did you want 3 short-term, 3 long-term for the action plan, and then 3 short-term, 3 long-term for the contingency plan?
No, I think for action plan 3 to 5 probably for short and long term. And then for contingency and risk, I would just think of like 1 or 2 risks. The risks and mitigations is always like total bullshit because like any risk that you're going to come up with, you're also going to come up with a fix for it, which like probably isn't realistic, but it's just something that you have to include.
So would you recommend like trying to back it up with like a qualitative or quantitative piece of reasoning for why it could be a risk?
Yes, sir.
And then should you, like if you say why it could be a risk, should you provide like a fix to it or no?
Pardon?
Like let's say you say like something is a risk, so you said, oh, to prevent this risk or something, they should do X, Y, Z.
Yeah, exactly. Would they likely prompt us in the case if we had to do a marketing plan? Absolutely. They would say, what should the 4 Ps be or something like that? And then you just make it up. But I don't think it would be expected out of nothing. There's something else there. Should we always do an action plan and contingency plan? Even if it doesn't say yes, you should always do action plan and contingency. The other day, some people were asking like, how do we know to do segment reporting and cash budget? Jack, I remember you were the person that said the answer. How do you do a segment report?
Yeah, so for
got
segment
all the
report,
free
you need your
passes
revenues
for
and expenses broken down by percentage, or your COGS.
Exactly, of all the different segments. And Jack, sticking with you, how do you do a cash budget?
They're gonna say like, prepare like they'll give you like dates like over 6 months, or they'll give you like, it's very obvious that they're gonna say like a cash budget. Like I remember in Adept, they said like they want to see the cash over the months and from July to whatever or something like that. So it's pretty. You just gotta look at
Exactly. It'll tell you the months that you have to do it for, and then it'll also tell you the timing of the cash flows during those months. Questions like that last one, I mean, what's my answer to that? I don't know. Say you pick an option, do the projected statements and the numbers are horrible, what do you do? Again, that doesn't really make sense because you're making your decision based off of your differential. And so if your differential is a good number, then, you know, that's also probably going to be a good number as well. Yeah, Mila?
Do you have any suggestions for our cheat sheet?
Yes, I would be putting the actual examples of like what a cash budget looks like, what a segment report looks like what all these pieces of analysis look like. So I would just be putting examples of pretty much everything. David?
Yeah, so I guess for payback period, there's like no reasonable range. You're kind of just, you're comparing it to the useful life, right? Okay.
Exactly. So for payback, you're comparing to the useful life. For an ROI, you're normally comparing it to some percentage.
Okay, exact first like 10 years looks like a lot, but when you look at that as useful life for 25 years, like, okay, yeah, 15 years of, yeah. Okay, thanks.
Exactly. Good work. Rock?
If we had to do, let's say, like a contribution, break even, cash budget, costing methods for segment reporting, what sort of things would be the most important things to like touch on, things that you're really looking for in that case?
It's a big question, man. Those are like 4 different subjects that each have their different things to talk about. I don't think I have a quick answer for that. I think it would be review the topic slides and see kind of what it is. But in essence, the cash budget is saying, can you meet your cash needs for the next few months? A segment reporting is looking at your profitability for each segment. Contribution and break even is looking at more specifically on like a product basis rather than the whole business segment basis.